Evening, everyone. I see quite a few people already in here. We'll put the chat up so you can drop some more comments in there. But I see a lot of people already dropping comments. Welcome. Good evening. We are back for our Tuesday night mentor meeting, aka our loan officer training. And today we're going to talk about how to structure DSCR loans and go through some great stuff here. So even if you've already done some of our trainings here about DSCR loans, this is definitely going to be a little bit different from a different angle. So we'll wait just a couple minutes for everybody to jump on. Like we always do, wait for us to go live on all the different platforms. It's still posting on some of the platforms. So go ahead and drop your comments there in the chat, and we'll wait to get started. Good evening, everyone. Lots of familiar faces in there. Dropping comments. Taryn says, "Hey, team from Michigan, Burr." Yeah, we're in Miami. It's pretty nice here today, but definitely cold. I know there's a lot more people on here that are cold as well. Hello, Matthew and Matthew, both the Matthews back to back. Hello, everyone tuning in. All right. Okay, I think we are good to go then, so we can go ahead and get started. All right. So, welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. So, every Tuesday evening at 7 p.m. Eastern, we do a loan officer training, what we also call our mentor meeting, where we go through some of the basics of being a loan officer and sometimes get more advanced as well. But today, we're going to take it a little bit back to the basics as far as what we do is the DSCR loans, right? So that is our flagship product, debt service coverage ratio, no income verification, no employment verification needed for the borrower to purchase an investment property, purchase or refinance an investment property. So we love these loans. We love to work with investors. Our team is very well versed in them. And today we're going to do our deep dive into how to structure DSCR loans and really how to think about them and conceptualize them, right? Kind of going from the start. So what I'm going to do is go ahead and turn it over to Jose, our sales manager with 27 years of experience as a loan officer and a realtor. And Jose's got a presentation here he's going to pull up so we can start talking about that. So go ahead there, Jose.
All right. Thank you, everybody, for joining us tonight. This is a very good topic. We picked this topic tonight because all the activity that we're having, all the leads that we're generating, all the loans that I'm disclosing for the team, I am really seeing the activity just off the charts. So, wanted to take advantage of this momentum that we're having because the rates are really doing very well on the non-QM. They don't necessarily track what's going on with conventional. With non-QM right now, there is liquidity. They have money available for all of these programs. So they're right now competing amongst themselves, trying to improve guidelines and improve pricing on all of the programs that we have. So if you see our daily mortgage rates live with the mortgage calculator, you'll see that those DSCR rates are tracking downwards. So very cool, very positive. So, I mean, with all of this business that we're generating, we want to, spread the word out there on DSCR loans. So as I always say in my trainings, if I were in an elevator with a realtor or an investor What program would I discuss? If I had my 30-second elevator speech, I would discuss DSCRs. That's it. I mean, this is the one that really makes their eyes bug. They just look at you like with this, quizzical look, like, really? I didn't know you could do that. So we're going to get into all of the reasons why we would have such wide-eyed realtors when we're talking to them about the DSCR loan. So first and foremost, I'm sharing some information here with you. So I want to get into the real basics here. What does DSCR, DSCR, that's actually 4 words, 4 letters. It's an acronym for debt service coverage ratio. That is an actual calculation. It's not really just the loan type that we're doing, but like Band-Aid and like Coke, it has entered our vocabulary to mean a loan type that uses the debt service coverage ratio to qualify the borrower. So again, what does that mean? I'm throwing it around using the debt service coverage ratio, but I still haven't gotten into it of the actual calculation. So debt service coverage ratio is a calculation, as you can see from the third bullet point there. It is gross monthly rent, however that is arrived at, which I will get at in more detail when I share some program guidelines. But gross monthly rent divided by the housing expense, which in this case, excuse me, is PITI, principal, interest, taxes, insurance, and if applicable, association fee. All right, excuse me a second. So again, it does vary how we arrive at the DSCR, and that is the main purpose of why we're meeting here tonight, because it's not just like all encompassing DSCR for everything, right? It's not like this is one of the, I guess, uh, perfect scenario, perfect situation is we get the email from some of our team. Hey, for a DSCR loan, can you do blank blank blank? So our response is usually, whose guidelines, what program are we going to use? Because not every DSCR program has the same guidelines. Pretty much every single DSCR program out there, and there are multitudes of them, have their own distinct guideline. So if you ever send us that question, uh, for a DSCR loan using XYZ's guidelines, can we blah blah blah? Okay, then we'll know how to answer the question, and if you need more clarification, send over the guideline with your question. We'll review it really quickly and get back to you as soon as possible with an answer. But again, I'll show you that when we actually go into the guidelines. So again, backtracking a little, DSCR, investment properties only, never primary, never occupied by the borrower. You cannot have a 2 and a 3 unit or a 4 unit property DSCR where the borrower is occupying one of the units. That is never ever going to be possible. You cannot structure DSCR loans for an investor that's going to occupy the property every now and then, like for short-term rentals, where he's going to do short-term rentals and then every now and then, it's not really meant. You can do short-term rentals for DSCR, but not where the owner expects to occupy the property at any given point or time of the year. That's not what a DSCR for. That's what we mean by it's investment property only. Right. So again, getting back to gross monthly rent. Now, again, very important when we are figuring out the DSCR, our debt service coverage ratio. I'll use that so it can sink in, because we have a plethora of options depending on if our option is 1.0 or greater. It's going to be, certain guideline requirements. If our debt service coverage ratio is 1.25 or greater, there's going to be other options, not just better pricing, but probably other options like the 85% LTV DSCR unicorn option, the one that everybody wants, that 15% down, but you need to have that really sweet property. And we do get a lot of those in Ohio, Pennsylvania, and a lot of those markets where they have good rents, but property prices tend to be 150, 160, 170, 180, but the rent could be $2,000. I mean, I just disclosed one where the DSCR was 1.7. Wow. So that person qualified for any program that they wanted to, the highest LTV. And if the credit is there, obviously, everything goes in line. But I mean, when you have that really high stratosphere DSCR, the sky's the limit. But conversely, we also have the programs for those properties that may still be great, but due to different reasons, the DSCR is not going to be 1.5. It could be 0.88, right? Maybe it's a great property. For whatever reason, you can't get short-term rentals, you can't get air DNA. The borrower is going to hit it out of the park with short-term rentals on it, but we can't really quantify it. That one odd lot example where we can't figure it out in that manner, that we have our 0.75, 0.99 option, and we even have our less than 0.75 option. Again, there are reasons to use those type of loan programs that are very valid reasons, as long as the investor is has a plan for what they're doing, and we can provide them the solution to get into it at 1.0, 1.25, or even less than 0.75, which happens again on a lot of our trophy properties, right?
Hey, Jose.
Yes, sir.
Sorry to interrupt, but I just want to make it clear. You're saying that even if the rent doesn't cover, even if it only covers 75% of the expenses, we can still do a loan on that property, even if it's negative cash flowing.
Yes, sir. Mind blower. What's that? Drop the mic moment. I dropped my mic, but I really like it. It's brand new, so I can't do that. But yeah, absolutely. We can do any type of property basically, as long as it falls within the guidelines. Yeah, less than 100% coverage, less than 75% coverage. Theoretically down to zero. They will need a 1007, which will be done. No property has a zero rent amount unless it's a property that can't be rented. Then you wouldn't be doing a DSCR loan. If it has damages, you'd be doing a fix and flip loan. So in this case, yes, sir. Even if it's not cash flowing 100%, we can do it. That's why it's so important for the team to first see, which I'm going to show you in a minute now, when we get a little deep into 3 separate guidelines of how we actually determine the income, because that's really where we can really shine here at the Mortgage Calculator, because we have so many different ways to look at the income. You can't limit yourself to thinking this is a conventional loan that just doesn't ask for income from the borrower. No, this is a totally different out there loan that has its own set of guidelines that are custom tailored many times for the market segment that they want to be in. And it's our job, our duty, to reach out and find all these different programs and find the best fit for our borrower. When you find that fit, it's like hitting that golf ball, in the perfect manner. You don't even feel it hitting the club. It's just you hit it and it goes 300 yards and you go, wow, I didn't even feel that one. Well, that's because
it's the sweet spot.
Yes, sir. Synergy, right? The sweet spot synergy. You found the program, you show it to the customer. The customer says, this is it, Jose. Wow, this is the one. Yeah, let's go. This is the perfect program. That happens quite a bit when we are going over the DSCR loan program for borrowers that may be experiencing this program for the very first time. And that's really what I need the team to, and everyone here actually listening, to understand that most people, when we are talking to them about DSCR, it is their first time that they're actually having it explained in such a detailed manner as we do, and then obviously going into the quoting and all that kind of stuff. But I'm telling you, those eyes are like saucers, right? So we have all the different program guidelines for if you're doing short-term rental. Well, I'll get that into the bottom part, but I want to know also, you all to know, real important here, no DTI requirements. This loan uses no personal income from the borrower. So due to using no personal income from the borrower, it 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 is not applicable for any DTI, debt to income calculations. It is all about the debt service coverage ratio. The debt service coverage ratio is the substitute for DTI. DTI would be applicable for a loan where you're using personal income of the borrower, whether it's an investment property, second home, or primary. It has a DTI calculation. The program, the DSCR, that does not use any personal income from the borrower, uses a debt service coverage ratio to qualify the borrower. Again, going back to our 0.75 to 0.99, 0.75 below 0.75, or 1.0, 1.25, 1.5, and so forth and so on. It's just a simple ratio calculation. So the DSCR loans can be used for many type of loans. We have them for the standard 1 unit, right? But then we have 2 to 4 unit. Keep in mind that on the 2 to 4 unit, we're not going to be able to do 85% LTV on a purchase. Usually, right now, that's limited to a 1 unit. That may come back though, because they are again competing amongst themselves, trying to get more business. So next thing you know, that could be there tomorrow. So be sure to ask. But right now, we have 1 unit at 85%. Again, the unicorn, and then a bunch at 80%, 75, and then those below 0.75 options are all usually at 70% LTV and below. But still, 70% is not much different from 80. So not a really big difference. So we can do cross collateralization on these, which means blanket loans. So those portfolio loans that you hear us talking about, that's not portfolio like a private portfolio of that bank. That's a loan for a portfolio to do a blanket loan on a whole bunch of properties is what that basically is there. So now, we also can do, one of the things that we love doing is short-term rental loans, short-term rental properties, investors with multiple properties and complicated tax returns, and self-employed borrowers. Hold on 1 second, please.
Yeah, so great program here for the investors, and they really love it. And not only no DTI, no income, but remember, no employment verification at all, right? So this is a lot of the people buying these properties, doing these, buying short-term rentals or buying rentals and refining them and buying more and doing the burr and all that kind of stuff. These people don't usually have traditional employment to qualify them. So that's what's beautiful.
Absolutely. So you get the people, for example, and Nick knows how we feel about when we get that investor with 30 properties, 35 properties, trying to do one of those full doc. I mean, I've done them. You end up with like a 300-page file, quote unquote, or you're doing all these income calculations, but typically those files don't end up working out full doc, not because we as an MLO don't want to do it, but just simply there's just so much going on there with the tax strategies of the borrower, that usually in the end, after doing all of that self-employment income analysis or whatever they're doing, we usually end up at the DSCR, right? So Now I'm going to go show you some actual guideline reviews, so you can see, here in this bullet point where I have here, all program guidelines are different. So this is another area where we shine, and this is why, especially when you're considering short-term rentals, for example, like we do, this is why we uncover all those nuggets, right? So let me go here into my next page here, and I am going to share the guidelines in a minute, but I wanted to, go a little bit deep into talking about, loan application tips, right? Things to consider when you're setting up your application and you're setting up your loan, right? Um, and then obviously, when I share the guidelines with you all, you'll see what exactly I'm talking about. But the guidelines for the program selected need to be reviewed to confirm what will be used to calculate the income for the transaction type. And it's really important now here because you need to differentiate between a purchase and a refi transaction that then is separated into a cash out or a rate and term. Rate and terms are going to have guidelines more similar to purchases, whereas refinances are looked at a little bit of a riskier transaction. Usually going to have the cash out is going to have lower LTVs. Cash out may also have a higher FICO score requirements, right? So there's going to be differences to look at. So then you're going to be looking at the matrix or matrices, in this case, of the multiple program options that you're considering. Because remember, it's not just about the rate that we're looking at here, it's the combination of the complete transaction. And obviously, this is something you discuss with your borrower because we always want to communicate all of our concerns with the borrowers to make sure we consult them properly to let them know, yeah, I mean, they don't know all the rates, all the different programs that we have. So we need to explain to them properly. Option A is like this, option B is like this, and option C is like this. And then they're going to want to know, which of those do you recommend? And then I like to tell them I like either A, B, or C for reasons A, B, C, D, E, F. We look at depending on the property type, could be an issue depending on certain issues with the credit, whatever it may be. We have different program options where we usually may prefer to send the borrower, and one may have a different rate than the other, but it's what's applicable and what's going to be able to close. And usually, if we set the expectations properly to the customer, to the borrower, and they understand why we're doing what we're doing, they're usually fine with it. You need to empower them. And this is only going to happen if you yourself understand the why of you choosing where you're sending it. And again, it's not just about the rate, right? So now we get to then a little bit more detail on the income calculation, right? And you'll see some examples of this when I show you guidelines, but income can be calculated on a DSCR a number of different ways. I mentioned it is market rent divided by housing expense, but now here is where we start figuring on different ways that are possible to calculate the rent. And then that is what's going to then let us know which is the program that we can actually select for this particular borrower. So again, we're looking at the 1007 market rent schedule. In some cases, in most cases or all cases, they're going to require, let's put it this way, they're going to require a 1007. It's what is put on that 1007 that can change, because with some of our program options, they allow, for example, short-term rental comps to actually be put on the 1007 as a comp. If we're lucky enough to have that in an appraisal and we're submitting it to a program that accepts that scenario, then you're going to have the maximum income of any deal. They'll usually put a haircut on it, which means they'll do an adjustment anywhere from 20 to 30% reduction of that gross amount for management fee, because they know there's a short-term rental management fee, but they'll let you use that. So that's going to give you astronomical income, but you wouldn't know that you could use it unless you reviewed the guidelines where you could see you could do it. So that's the 1007 market rent schedule, which again, if you can find that unicorn, that one comes without an LTV adjustment at the programs that allow it. So we do have program that allows the short-term rentals to be put on there without an LTV adjustment. That's very critical, knowing that LTV adjustments usually are going to be applicable when using short-term rental incomes. Again, you got to check the guidelines. Air DNA.
Hey, Jose, real
Yes,
quick,
sir.
I'm sorry. Just to go all the way back to the basics for the very new people. So 1007 market rent schedule. So what this is that they're going to come out and do an appraisal, right? Just like a regular appraisal that they would normally do for the price of the property. But a 1007 is something the loan officer is going to add to the order of the appraisal in order for them to calculate the rent. So they're going to get an appraisal with not just the value of the property itself to sell, but they're going to get a market rent schedule, right? So that's what we mean by the 1007 is the appraiser comes out and they're going to give us two calculations, or if we can get short-term rental, I guess they'll basically give us three, right? So that's what we mean when we say 1007.
And
that's a little bit of a misconception. It's not three; it's a replacement value, right?
So okay, so they're going to replace it.
They're going to replace long-term rents with short-term on the 1007. So it's two reports always.
And I guess the other thing to consider regarding the 1007, I was going to say it, Nick, and then you started talking and I forgot. Sorry. Okay, so market rent, again, could be long-term rent, could be short-term rent. So now another option here that you could use for the pricing is AirDNA database. And this is on purchases only. They do not let you use AirDNA on refinances because usually they feel if you've already owned the property, the only way they're going to accept short-term rentals on a refi is short-term rental revenue reports. Unless you happen to pick the option that allows the 1007 and we were able to get the short-term rental comps on the 1007, then they let you use it without any restriction on time. So again, we get back to structure, reviewing the guidelines and seeing how we can use those guidelines to our advantage. Because you can look at it, and I'm going to show you those three guidelines in a minute so you can see how they are. 3 DSCR programs, 3 different ways to look at it, right? So now another way income can be calculated on a DSCR is short-term rental revenue reports. This is possible for both purchases and refis. On a refi, it's going to be provided obviously by the property owner, but on a purchase, if the property owner is cool and wants to sell the home for top dollar and has 12 months of short-term rental revenue reports, he's going to say, sure, man, I got Airbnb, I got VRBO, I got HomeAway, I got TripAdvisor, I got them all. I got them right here already in a PDF file. Where do I send it to you? Boom. Because, any smart seller would have that if they know that they're going to be selling their property for maximum value. All they got to do is collaborate with some of the data. And then the fourth way that we can income can be calculated on the DSCR is lease on a current tenant, right? Whether it's a refi or whether it's a purchase. For purchases, need to be sure that the lease is going to be assigned at closing. Sometimes the underwriters will actually ask for that as a condition. If your lease income is higher than the 1007, that's the hack, right? If it's a refi, you need to show 3 months receipt of the rent. If it's a purchase, they're not gonna ask you for the seller for, hey, did this guy pay you for 3 months? But they'll ask like for the assignment of the lease at that dollar amount. And usually we've been able to use that as a workaround to get the lease value when it is higher than the 1007. So again, 1007 could be long-term rents or could be short-term rents. So we covered here, basically here, how, 4 different ways that income can be determined on a DSCR loan. So now you all are seeing not every DSCR loan is created equally, right? They all have a bunch of moving pieces The only thing in common a lot of times is you're not using the income of the borrower, and it's a DSCR loan, right? So now you want to make sure on the application that you set the rental income at 100%, right? Not 75%, but 100% on a purchase or even on a refi, even if it's an unseasoned rental. This is different than an investment property purchase where you use 75% of the rental income, uh, or a refi of an unseasoned rental that you haven't reported yet on your tax returns that you use 75%. On the DSCR loan, you put 100% below the rental amount value. And remember, the rental amount you got from one of these four methods. And it's also going to be on page 1 and page 4 of the application where you got to set that at 100%. Make sure you got the correct loan template for DSCR. This is some housekeeping stuff here, but it is applicable for a reason. Make sure you have your 2 years of housing history and, if applicable, a rental payment amount. Why do I say this? Because in most DSCR loans, housing history is a requirement, either showing housing ownership, where they could either have a free and clear property that they're paying taxes on, or they could have a loan on a property, or they have to show rental history through either a verification of rent from an institutional landlord or an actual payment history showing payment debits for 12 months. So that is critical on the DSCRs. We do have, I believe, one, maybe two options where they can have no housing history at all. But again, like everything else, with the risk comes a little bit higher rate on that option. So the lowest cost option is always going to be the borrower that has investor experience, which is going to be my next bullet point. Well, next to next. Leave page 2 of the application blank. I love that part. Make sure you click does not apply as applicable on all those fields asking for income, prior employment, all that stuff. Blank. Make sure that you delete any income that may show on the bottom part, because sometimes the income does transfer over from real estate owned section. Then investor experience is a plus on all these DSCR loans. So if we document it properly, we're only helping our cause, right? So how you properly document this is in page 3 in Encompass in the VOM tab. There's a little tab there on the upper right hand there, right by where the properties are. And most people's mistake is they don't click that tab to fully input all of the subject property info as well as all of the other real estate that the borrower owns. Critical that that be completed properly, especially for the subject property when it's a refi, right? Cash out refis, especially. We're looking at seasoning on title, all that important stuff. If it's not there, it's going to be conditioned possibly, right?
And not only do you put it there, you got to fill out every detail, right, Jose?
Yeah, that's
can't check seasoning if you don't put date purchased in there, right? So nobody
yeah.
knows what you're trying to do if you don't fill out all the info, guys. So
the exact date. There's another section in the application a little bit before this one where you put the year that they purchased and it transfers what they owe on there if you have it properly filled out on page 3. And you can put there how much they spent on improvements and what they've done. Real important stuff, by the way, to put. But the actual exact date, like January 5th, 2021, does not appear except on page 3 if you click the VOM tab and properly complete the whole section. So you do need to click that tab to properly complete everything there. And very importantly, please, oh please, match the liabilities. Match the liabilities of the assets of the real estate owned, which means, very important, a lot of times, there's loans not on their credit report for multiple properties that they may have. A lot of these investors are really active. They may have a couple of fix and flips there that they're finishing up. Maybe they've had them for a year, maybe they haven't, but they're not on their credit report, but they're in the LLC, so they're on the application. So just because it's on the credit report doesn't mean it doesn't exist, right? You're setting yourself up for unnecessary conditions unless you take the necessary step. You see that bullet point I have there on the bottom. Loans for REO on the application, not on the borrower's credit report, need to be manually added via the VOL tab. Another little tab looks just like the VOM tab, but it says VO. It's above. It's right there where the credit liabilities are and all that. On page 3, you just click VOL, and then you click the little paper icon with a little plus to add a new account. And then even if you don't know the name of the investor on that loan, even if you don't know what they owe, even if you don't know the balance, you know what? Open up an account, put private loan, at least so you know you got to put something in there, and click match the liabilities, right? At least match it to something, and now you know, okay, I got to find out what. And usually, when I'm doing the meetings with the MLOs, most of the time they're able to reach out to the borrower, at least find out what they owe and what they pay, so at least we can fill that out, and then they follow up with a mortgage statement or a copy of the note and the payment debits or whatever you need to get your verification of mortgage completed. That's all hand in hand when you have these undisclosed, or should I say, not undisclosed, but loans not on the borrower's credit report. So it's real important to tie everything in, do all of your housekeeping, because many times people show up to disclose their files and they got like 4 properties on the application. And I'm like, are these properties free and clear? No. Okay, so where's the liability to match to? Oh, don't got it yet. Oh, wow. So then I got to be creating 4, and then they got to be doing some quick texting and calling and trying to set it up that way. So please, oh please, real important to set all that up. And again, we're talking DSCR here, right? We're not talking DTI. So yes, the DTI doesn't come into play, but the payment history does come into play. And you don't want to have your loan delayed because all of a sudden you find out that free and clear property is not free and clear, right? And now all of a sudden you have to get a payment history or a VOM, and you're trying to close in 4 or 5 days. So don't get on that. Just dot your I's, cross your T's. So now I want to show some guidelines here, 3 different guidelines here, so that you can all see what I'm talking about, right? So this one here, let me try to see if I can, well, it doesn't really make it much bigger here, but let's see, make it a little bit bigger here.
Yeah, you can zoom in. There you go.
Makes it a little blurry for y'all, but I hope you can all see it good. Okay, so again, I'm going to show you here 3 excerpts from 3 different program guidelines so you can see how they're all different. So there's different reasons why we would go to each one, but everyone a lot of times is just looking at rate and not looking at the other factors. And this is the mindset that I want to create. And everybody is like a holistic approach, right? Looking at the whole transaction, not just a rate, and conveying that to the borrower, because that's what's going to make you a consultant and what's going to make the borrower really appreciate what you're doing for them. So look at here, it says rental income will be documented by reviewing the rent schedule on the appraisal and in place lease for rented properties, right? So if the property is rented, lender must obtain the current lease for the property. The lower of the lease or rent schedule must be used. So no, they're already telling you there's some givens. That's like must. That's like no choice there. If the property is vacant, the rental income from the rent schedule will be used. But beware that they may not have vacant property LTV adjustments. Okay, so I haven't looked at that part in this, but that is an issue sometimes. And then for our purposes, to calculate the debt service coverage ratio, the seller must divide the qualifying rental income, whichever of the lower options is being considered, by the sum of principal, interest, taxes, insurance, and any other applicable fees. So you see that one there, right? That one doesn't really look like it's going to do a lot for us. Looks a little bit difficult. So now let me show you number 2 here. Okay. Let's get this one a little bit bigger. All right. All right. So this is one of our more flexible ones, right? This is the one. Well, I'll read it and then I'll give you my interpretation. But look at here. It says to calculate gross income, actual rent, or rental valuation from 1007 may be used. So look at that. Actual rent or rental valuation from 1007 may be used. Actual rent reflected on the 1007. And then 100% of long-term rental value will be used for qualification purposes. They're also telling you their lease agreement, new lease is acceptable for purchase transaction only on seller's name with 3 months payments, first and last month, and deposit. This is if it's a new lease on a property that you're purchasing, you need to show that kind of information, not an existing lease, right? Then if there is no actual rental lease available for review, right? Then rental valuation on the appraisal will be used. So now, let's see, now they're giving us options here. When a short-term rent is used for DSCR calculations, so notice you're saying short-term rental agreement. That is the short-term rental reports using 75% of the rent. And second. And then that's that 75% haircut that I told you about. 1007. So if you get, and I actually did see this on a file where they we were able to get short-term rental comps actually on the 1007. So it wasn't like a narrative, it was like actually put the comps in there. And then note that they'll use 75% of the short-term rental value, like I mentioned, the haircut. So again, a lot of options here, and they'll use any of those three options. So, just see how you present it. And now we go with option number 3. This one here, just really easy.
Full screen it for us, Jose.
Oh, sorry about that. Let me make it a little bit bigger here. So debt service coverage ratio, they're just basically talking about 1007. Minimum DSCR is 0.75, just pretty basic stuff, right? Executed lease agreement or market rent from a 1025. And then if the lease payment is higher than the 1007, they want 3 most recent consecutive months. Oh, now I remember what I was going to say when it was in the tip of my tongue. 1007 is, we use that term also like DSCR, because 1007 is actually a market rent schedule for a 1-unit property. But if it's a 2 to 4 unit, it's a 216 operating and income expense statement, right? But the only part of it that we use is just the income part. We're not really concerned with the expense part, but for whatever odd reason, they that's the one that we use, the 216. So you see here in this example, pretty basic on the DSCR. Let me make sure it's not the same one. Yeah. So, three different DSCR programs, 3 different ways that they calculate income. Now, what I didn't get for this one was that in short-term rent, they because they actually have it in a separate section just for short-term rentals, they don't do any LTV adjustment with this particular program either.
Hey, Jose, a couple things I just wanted to touch on. So I had a LO ask me about this. So you'll notice in none of these does it talk about operating expenses, right? So I had somebody send out a quote saying that it's the gross rent minus the operating expenses to arrive at your scenario. But notice none of these say anything about actual operating expenses or using any of those. We're going based on the gross rent, right? There is no minusing anything for operating expenses or anything like that. Unless, I guess, in this case of short-term rental, they may give it a haircut. But
Yeah,
there is no, okay, there's this management fee, or it costs for the these are the costs of operating the property, right? We're going based on the gross. We're not breaking it down into expenses.
that's the beauty of it. Exactly. This is based on the gross income, so we don't have to worry about any of that stuff. If any of that stuff does come into play, the guidelines cover it. What I did want to show here, I almost missed this point, is for everyone to note the little asterisk, the little gray asterisk here. Maybe I gotta make it a little bit bigger, right? The little asterisk right there after the A, and then notice what it says: for interest only loans, the DSCR calculation allows for the use of interest only payment, including escrows. So that's why they have the P, which is principal here, in brackets, because this investor has interest only options and allows the DSCR calculation to be calculated using interest only. They all don't allow that. So again, a nice little benefit of scouring the guidelines for nuggets of gold. Right?
Hey, Nick, you had a client, I remember, that you took from basically not being able to do anything to being able to do interest only DSCR, and now they're cash flowing like an insane amount, right? Do you want to touch on that?
You mean for like the portfolios stuff, or what do you?
No, I remember you had a client where you just had to do an interest only to get them in there, but because the interest only payment was so low that they were just cash flowing like crazy, right? And so they were a happy camper.
Yeah, I mean everybody likes that option. So when we switch over to that option, it typically increases our cash flow. Most investors are going to refinance before the end of the 10-year interest only period. So it's kind of a no-brainer for them, especially if they're looking for cash flow. So yeah, definitely happy to say, hey, we have to go up in price a little bit, but the payment's going to go down by, I think you're talking about the guy with the portfolio that we did 8 loans for or whatever. So
yeah, I think it was.
Yeah. So it went from, it was barely covering to we switched everything to interest only. And now instead of, he was cashing out everything to buy more, but he was going to have, basically break even on all the cash flow of one. But then when we switched to interest only, now he basically was able to make another 10 grand a month, from those properties, from switching to interest only. So freed up a lot of cash for him, and he's going to refi, I'm sure, before the end.
Absolutely. All right, Jose, back to you.
Cool. Yeah. So plus on those interest only, by the way, 40-year goes hand in hand with interest only. So 40-year amortization, interest only. Now, do be aware that obviously there will be pricing adjustments for an interest only option and a 40-year amortization, but check your DSCR, and if that's what you need and that's what's going to make it happen, more than one loan has been saved above 1.0 DSCR and going maximum LTV by using this, because the only way you're going to go maximum LTV is above 1.0 for sure and above 1.25 definitely.
The easy way to explain it, most of these option guys are a 40-year loan, and essentially it's a 10-year interest only period. So you're only paying interest, and then at the end of that, it's still a regular 30-year loan that you would have got today, right? So it's a 30-year fixed loan at the exact same balance that you have at the start, because you're paying interest only at the first 10 years. So it's interest only 10 years, and then the regular 30 years kind of tacked on the end, basically. So it should be relatively easy to explain, even though it's not many people know it exists out there, right? And it's not 40-year amortization or whatever, which is different than a 40-year interest only, because it's not actually amortizing for 40 years, because there's a 10-year interest only. There's no amortization going on there. It's not lowering the balance, right? It's then after that is when we finally start kicking in a regular, fully amortizing 30-year loan. Anything to add on that, Jose? Because a lot of people don't understand how that
Yeah, just to note the same thing with a HELOC that's interest only for the first 10 years becomes a 20-year fully amortizing adjustable rate loan after 10 years if they don't refi. The 40-year loan, if they decide to make payments during the first 10 years, the principal, it amortizes on a 40-year amortization. Most people, though, on that option just choose the interest only option. And then at the end of 10 years, if you still have that loan and don't refinance out of it, it converts then to a 30-year fully amortizing loan.
Always the same rate though, right? So we
Yeah.
lock it at 7 today. It's 7 the whole time of interest only, and then it turns into a 7% 30-year fixed at the end of that 10-year period. And typically nobody pays it down if they don't have to. So typically it's, like I said, it's the same loan today of 30-year fixed. We're just pushing it towards the end, and you're paying interest only in the interim, the 10 years.
Yep. All right. So, I mean, we've covered some really important points here regarding structuring. I think that if once everyone gets into the flow of knowing, just this is just like following steps, it's just same steps over and over. You're going to learn all of these guidelines. You're going to know, obviously, you can't just save the guideline and reference it 6 months later. They change. So you have to reference these guidelines continually. Make sure you have the latest and greatest version of it. But this is what's critical to being a successful loan officer, and this is going to apply not just for DSCR loans. This is for every loan type out there. It's going to be the same thought process and the same analysis that we're going to do. So definitely looking forward to helping everybody out structure these deals. We're doing a lot of them right now. So, keep them coming.
We got one question here. Can we have escrows? Most of these programs, and typically any of these non-QM, as long as it's not a high price mortgage loan, we could waive escrows, but anything HPML requires escrows, right? So a lot of times we're running into HPML when we do these non-QM loans, especially DSCR. So kind of a trick question there, Christina. Jose, you want to add anything to that?
Yeah, no, yeah, HPML meaning high price mortgage loan. So that's just it. Just read your guidelines, and if it is high price because of the fees, then you have to escrow. Other than that, just make sure that you price it accordingly if they are able to waive escrows, because there's usually some type of an additional fee to waive escrows. Usually it's like a quarter point, somewhere around there, to be able to waive escrows. But keep in mind, misconception, a lot of times people think that they're waiving escrows. That means we don't consider it in the debt service coverage ratio calculation. We definitely do. We consider the complete housing expense, principal, interest, tax, insurance, because listen, they don't pay the association fee to the bank, right? But it's a housing expense if there is an association applicable. We have to analyze all of the components of the payment as one, and that's just the way we do it.
And luckily, DSCR doesn't take any other expenses, guys. That's pretty amazing, right? In the typical commercial world, they want to know your trash bill, right? They want to know your electricity bill. They want to do a full analysis. Debt service coverage ratio is just, can the rents cover the mortgage? If you can't afford the electricity, they're like, well, you better pay your mortgage, right? So,
absolutely. I guess that's one example that I should put on my presentation there about what is a DSCR loan good for. Is the guy with the Lamborghini or the Ferrari, has like a $10,000 a month car payment. No worries, man. This is DSCR.
Yeah. For the borrowers, for DTI challenge borrowers, right? A lot of times we get a challenge with DTI, and this solves that for sure. A lot of other comments just about want to record this and stuff. So I don't think there's a specific on these loan types.
And yeah, this is recorded. It'll be up on our YouTube page, so you can come back to it. So, All right. Well, thank you, Jose. That was awesome. I hope that gets everybody's mind in the right mindset there for the different types of DSCR loans there are. And like you said, just different types, just the way to approach these loans in every loan, right? The different guidelines. So we'll go ahead and wrap it up, though. Appreciate everybody tuning in. We have the sales training, loan officer sales training tomorrow that we do every Wednesday at 7 p.m. Eastern. And then again, we do this every Tuesday at 7 p.m. Eastern. And we have our daily mortgage rates live at 11 a.m. Eastern every weekday, where we go through the different rates so you can see how they fluctuate live. So appreciate everybody tuning in. Thank you. Hopefully we'll see you tomorrow at 11 a.m. Eastern and at 7 p.m. Eastern as well for the sales training. Everybody take care. Have a good night.
Thank you, everybody. Good night.
Thank you.